Right now, at this very moment, there's a confession sitting in plain sight that most working Americans have walked right past. Not because they are not intelligent enough to understand it, but because nobody in the mainstream financial media is connecting what it actually means. What I am going to walk you through today is built on a real documented statement from the highest levels of the United States government. A statement that, if you understand its full weight, permanently changes the way you look at every price, every market report, and every financial decision you have ever made. This is not speculation. This is not doom scrolling dressed up as analysis. This is the logical, step-by-step unfolding of what just happened and why the average American needs to know about it more urgently than almost anything else on their radar right now. If you are new to Element Axis, subscribe right now and hit that notification bell before we go any further. I am serious about that ask, not as a formality, but because what we cover here is exactly the kind of conversation that gets quietly buried. These are the discussions that do not make the rotating panel on cable financial television, because they make the people running the system look bad. Turn on the bell so you are here when the next development drops. Now let us get into this. For decades, anyone who suggested that the United States government or the major financial institutions it works alongside had any meaningful hand in managing commodity prices was immediately dismissed, called paranoid, called a conspiracy theorist. The narrative was carefully maintained that American markets are the most sophisticated, transparent, and honestly priced in the world. Prices respond to supply and demand. Millions of buyers and sellers acting in their own interest set prices organically. There is no centralized control and no coordination. That was the official story. That was what they needed you to believe. And for a remarkably long time it worked. But something just cracked that story permanently. A senior White House official, speaking directly to reporters on background, openly acknowledged that the Treasury Department is preparing measures to address rising energy prices, and that those measures include using oil futures markets as a direct tool to bring prices down. Read that once more, slowly. The United States government just publicly admitted that it intends to use the futures market to manage oil prices, not observe them, not respond to organic movement, manage them, control the outcome, intervene in what is supposed to be an open price discovery mechanism to produce whatever result is politically convenient at any given moment. That is the confession. And I want you to understand why it is so significant before we go any further, because the implication of that admission extends far beyond the price of gasoline. When you acknowledge that the futures market for oil, the single largest and most liquid commodity market on Earth, is subject to deliberate government management, you have opened a door that cannot be closed again. You have confirmed that managed prices, not free prices, are how these systems actually function. And once you accept that as fact rather than theory, you are forced to ask the question that makes this whole conversation so important. If they are openly doing it with oil, where else has it been happening all along? Drop a comment below and tell me where you're tuning in from tonight. Whether you are in the South, the Midwest, out West, or somewhere overseas. Let me know. I want to understand who is in this community and who is paying attention to what is actually happening beneath the surface of the daily financial headlines. Because what we are covering tonight touches every single person on this planet, regardless of where they live. To really grasp what is at stake, you need to understand the structure that has underpinned American financial dominance for the last 50 years. It has a name that most people have heard, but very few genuinely understand: the petrodollar system. And understanding it is critical context for everything else in this conversation. Here's the short version. In 1971, the Nixon administration ended the convertibility of the US dollar into gold. Before that point, dollars were directly backed by gold at a fixed rate. That gold backing made the dollar credible globally. It was not just paper, it was a claim on something real, finite, and universally valued. But managing that gold peg was constraining. It limited government spending. So it was ended. The dollar became fully fiat, backed by nothing except the word and the power of the United States government. That should have been a serious problem for the dollar's global standing. Without gold backing, why would foreign nations hold dollars as their primary reserve currency? The answer came through a deal struck with Saudi Arabia and the Gulf nations. Oil, the commodity that every industrialized economy must have, would be priced and sold exclusively in US dollars. Every country that needed to import energy would need to first acquire dollars. That created permanent, structural global demand for the American currency, regardless of how recklessly the government spent or how much the printing press ran. In exchange, the Gulf states received military protection and security guarantees. It was a mutually beneficial arrangement. And for 50 years, it held. What this system gave the United States was extraordinary financial privilege. It could run deficits that would have been catastrophic for any other country. It could finance military operations across the globe. It could export the inflationary consequences of its money printing to the rest of the world. Every central bank, every oil importing nation, every company involved in international energy trade had to maintain dollar reserves. That built-in demand cushioned the United States from consequences that would have arrived much sooner for any other currency issuer operating the same way. If you are in your mid-40s or 50s watching this, you have lived the downstream effects of this system even if you did not have a name for it. You watched good manufacturing jobs disappear from communities across this country. Not because Americans stopped wanting to work, but because the financial architecture of the dollar made it cheaper to produce overseas and import here. The steel towns, the auto plants, the textile mills, whole industries that built a genuine working-class standard of living, were replaced by warehouses and service jobs that do not carry the same wages or security. The arrangement worked brilliantly for certain interests and quietly hollowed out certain communities for decades. And now that arrangement is under pressure, unlike anything it has faced in its 50-year existence. The Gulf nations, Saudi Arabia, the UAE, Kuwait, Qatar, are actively reconsidering their relationship with the dollar. These are not casual conversations. They are substantive discussions about pricing oil and other currencies, about building financial relationships with China and Russia that do not flow through the dollar-centric framework. They see the balance sheet, they see the trajectory, they see a currency being printed in quantities that raise serious long-term questions about its value. And they are quietly, methodically, beginning to explore their options. The reason the government just admitted to using oil futures markets to manage prices is because the petrodollar system is cracking, and oil prices are becoming politically dangerous. They cannot afford $7 gasoline. They cannot afford the visible evidence of what their monetary policy actually costs. So they intervene openly because the alternative, letting markets honestly price the consequences of their decisions, is politically impossible. They have chosen the managed fiction over the honest price, and they just told you that is what they chose. Hit the like button right now if this is landing for you. And share this with someone in your life who is trying to make sense of why their financial life feels harder than the numbers on paper should make it feel. This is the context most people are missing, and it costs nothing to share it. Now let me bring silver directly into this picture because this is where the personal financial implication becomes most concrete. The suppression of silver and gold prices is not a side effect of the broader monetary management operation. It is central to how the whole thing functions. Here is why. The most visible real-time indicator of currency debasement has historically been the price of precious metals. Gold and silver have been humanity's reference point for the value of money across every civilization for thousands of years. When a government inflates its currency, when the purchasing power of paper money is eroding, the price of gold and silver rises because the metal itself does not change. An ounce of silver today is the same ounce it was 100 years ago. What changes is how many dollars it takes to acquire that ounce. As dollars multiply, more of them are required to buy the same real asset. That is the honest signal precious metals send. But that signal is profoundly inconvenient. If silver and gold accurately reflected the true degree of monetary expansion over the last 20 years, the trillions created through deficit spending, through quantitative easing, through emergency programs, the prices would look nothing like what you see on a screen today. They would be multiples higher, and those prices would be a constant, visible, impossible to deny indicator that the purchasing power of the dollar has been seriously and systematically degraded. People would see it every day. They would move savings out of paper and into hard assets. The entire management operation would become much harder to maintain. So the major bullion banks, large financial institutions holding massive short positions in the futures market, actively work to prevent the visible price from reflecting real supply and demand dynamics. They sell paper contracts representing metal they do not actually hold in their vaults. This artificially increases the apparent supply in the paper market, pushes the price down, and keeps the warning signal muted. It is systematic, and it has been running for a long time. But here's the fundamental limit. You can create paper contracts indefinitely. You can push a screen price wherever you want it in the near term. What you cannot do is manufacture actual physical metal. You cannot print a silver bar. You cannot add real ounces to exchange vaults by typing on a keyboard. And the registered physical silver in those vaults, the metal that is supposed to back the paper market, has been steadily draining for an extended period. More metal leaves each month than arrives. The registered inventory sits at historically low levels, and the trend is consistently lower. If you have purchased physical silver recently, you already saw the evidence in the most direct way possible. The premium you paid over the spot price, the gap between what the screen said silver was worth and what a dealer actually charged to put real metal in your hands, is not just a handling markup. It is the physical market's honest assessment of real supply and demand at the point of actual transaction. It is the price the physical world sets, when it is not subject to the paper manipulation that dominates the futures market. And that premium has been widening. The divergence between the managed paper price and real physical pricing is the crack in the foundation of the suppression operation. And now the government has just confirmed the exact same playbook openly with oil They have volunteered in a press statement what years of careful observation had already strongly suggested about commodity markets. The Confession on Oil validates everything serious analysts have been saying about precious metals price management for years. You cannot call it conspiracy theory when the administration is volunteering the methodology. Drop a comment below and tell me, did you already suspect this was happening, or is this connecting dots you had not fully connected yet? The quality of the conversation in the comments matters, and I read every single one. Let me give you some historical grounding now, because I believe the pattern of what we are watching is the single most powerful way to understand where this leads. In 301 AD, the Roman Empire was deep into a sustained inflation crisis with a straightforward root cause. Roman emperors had been systematically reducing the silver content in the coinage for generations, funding military campaigns and government operations by minting more coins with less actual metal in each one. It worked for a while, the way all currency debasement works for a while. But eventually prices rose to compensate. Merchants raised what they charged. Inflation became visible and painful across the empire. Emperor Diocletian's response was the Edict on Maximum Prices, a declaration that prices throughout the empire simply could not exceed certain levels by law, with death as the penalty for violation. The result was predictable in retrospect. Merchants stopped bringing goods to market rather than sell at a forced loss. Shortages appeared where abundance had been. Black markets developed where real prices could be negotiated beyond the reach of the decree. Within a few years, the edict was effectively abandoned because no amount of legal force can make an economy function when the underlying monetary foundation is broken. You cannot decree your way out of a currency problem. You can only delay the honest reckoning while making it larger. Now, observe the present. Multi-trillion-dollar deficits. A central bank balance sheet expanded to levels unimaginable 2 decades ago. Decades of real purchasing power erosion for working Americans. And now faced with rising energy prices that are themselves a symptom of all of it, the response is to announce market intervention to manage the visible price signal. Different century, completely different technology, exactly the same fundamental logic. Suppress the honest symptom, hide the honest price. Buy more time while the underlying problem continues to compound. Rome tried it. Weimar Germany tried it in the early 1920s before one of the most devastating hyperinflationary episodes in modern history. Zimbabwe tried it. Venezuela tried it. Argentina has tried it repeatedly. In every single case, there was a period where the authorities pointed to managed prices and official statistics as evidence the situation was under control. In every single case, the underlying economic reality eventually overwhelmed the institutional attempts to contain it. The timing varied. The specific trigger varied. The direction was consistent every time. I want to be precise here because precision matters when the subject is this serious. I'm not predicting that the United States becomes Zimbabwe. The American economy has genuine structural strengths. The dollar carries significant global standing that will not evaporate overnight. These institutions are large and durable. What I am saying is that direction of travel matters. Trajectory matters. And when the people managing the system start openly acknowledging that they use commodity futures markets to manage prices, that is a significant data point about where we are on a very familiar historical map. Now let me make this practical, because understanding the risk is only valuable if it informs action. The core principle here is not complicated even if the discipline to act on it requires thought. When paper currency is being systematically debased, when purchasing power is being eroded by monetary policy and deficit spending, the historically proven protection is consistent. Hard assets, physical things that cannot be printed, cannot be inflated away, cannot be created by institutional decree. Things whose supply is genuinely limited by physical reality rather than by policy choice. Gold is the traditional answer and remains a powerful one. But for most working Americans in their 40s and 50s, who are thinking seriously about protecting what they have built, silver has specific characteristics worth understanding clearly. First, it is accessible. The barrier to entry for physical silver is low in a way that allows you to begin wherever you are financially. You do not need significant capital to start. An ounce at a time is a legitimate entry point. Second, silver carries real industrial demand that exists entirely independently of its role as a financial hedge. Solar panel manufacturing, advanced electronics, medical applications. The industrial need for silver is structural and growing as technology advances. You are not buying a pure speculation on monetary collapse. You are acquiring something the world genuinely needs more of. Third, the silver market is substantially smaller than gold, which means that when the suppression in the paper market eventually cannot be maintained, and physics says it cannot be maintained indefinitely, the price response has the potential to be more dramatic precisely because the market itself is thinner. But I want to be direct about what this is and what it is not. Buying physical silver or gold is not a short-term trade. It is not a play you make because you expect to flip it next quarter for a gain. It is a decision to hold a portion of your wealth in a form that is insulated from the specific risks that every paper currency faces, a form that does not depend on any financial institution's solvency or any government's fiscal responsibility, a form that has outlasted every empire and every currency that has tried to replace it. This is wealth preservation. This is financial insurance. This is opting out of the managed delusion with the portion of your wealth you choose to ground in physical reality. History on this point is not ambiguous. People who held gold and silver through Rome's monetary collapse preserved purchasing power when those holding coins saw their savings destroyed. People who held gold through Weimar Germany's hyperinflation bought property and goods for fractions of what they cost in inflated paper. Not theory, documented historical pattern. Consistent across every currency crisis because the underlying dynamic is consistent. Governments always print more. Currencies always erode. Physical assets always outlast the paper promises built around them. Let me tell you the specific things I'm watching as this develops, because I want you to have concrete indicators to follow, rather than just a general framework. The first thing I am watching is any formal announcement from the Gulf Cooperation Council regarding oil pricing and alternative currencies. The behind closed doors conversations are real, and the public signals have been building. Even a partial pilot program allowing non-dollar settlement for a portion of oil trade would represent a genuine structural shift with immediate consequences across every dollar-denominated market on Earth. The second thing I am watching is registered physical silver inventory in the major exchanges. This is public data. The trend has been consistently lower for an extended period. Every month, more metal leaves than arrives. There is a point at which the paper price and the physical supply reality cannot maintain their divergence, and that point gets mathematically closer with each reporting cycle. The third is the premium spread at physical dealers. When the gap between spot price and actual physical purchase price starts widening noticeably, when products begin showing extended shipping times or out-of-stock status, the physical market is telling a different story than the managed screen price. Those premiums are the most honest signal available in this environment because they represent actual transactions at the point where paper meets physical reality. And the fourth is the Federal Reserve's trap position. If they cut rates to support economic activity, inflation risks reigniting in a way that hits working households hardest. If they keep rates elevated, the cost of servicing the national debt at current debt levels becomes increasingly unsustainable. There is no clean exit. There's only the management of which crisis becomes most visible at any given moment. And that management now apparently includes openly admitting to commodity futures intervention. If you are already holding physical metals, drop a comment and let me know how long you have been doing it and what your experience has been. If you are just starting to seriously think about this, share that too. And if you are still skeptical and working through the logic, I genuinely want to hear from you as well, because that conversation matters. I want to close with something that deserves to be said directly, because I know that absorbing this kind of information can feel heavy. When you start to genuinely see the pressure the global financial system is operating under, when the mechanism becomes clearer rather than just the managed surface of it, it can feel paralyzing. The forces involved are large, the institutions are deeply entrenched. It is natural to look at all of that and feel like there's nothing one person can do. But here's the perspective I think is more accurate and more useful. You do not need to fix the system. You do not need to reform the Federal Reserve or rewrite international currency agreements. All of that is beyond any individual's control and beyond any individual's responsibility. What is absolutely within your reach is protecting yourself and your family, making deliberate, informed choices about how you hold the wealth you have worked to build, reducing your real exposure to the specific risks that the dynamics we discussed tonight create. That goal is completely achievable. Wealthy families have always done this. For generations, people with significant financial resources have held hard assets alongside paper ones precisely because they understood that paper promises carry consistent historical tendency toward debasement, dilution, or outright failure. That knowledge was never a secret. It just was not being communicated in language that spoke directly to working and middle-class Americans who needed it just as much. That gap is what this channel exists to help close. If tonight gave you something useful, a clearer picture of what the oil manipulation admission actually means, a better understanding of petrodollar pressure, a more concrete sense of silver's role in this picture, hit the like button. Share this video with someone in your life who is trying to make financial decisions without this context. And make sure you are subscribed to Element Axis so you are here when the next layer of this story develops. Because it is developing. The window for making thoughtful, informed decisions about financial positioning is still open. But it does not stay open indefinitely. The time to get clear on the risks you face and act on that clarity is while things are still functioning relatively normally, not after the obvious crisis point arrives, and every other person is trying to make the same moves under the same urgency at the same time. History is not kind to people who waited for certainty before acting on clear signals. The certainty always arrives too late to be useful. The signals we are seeing right now, a government openly admitting to commodity market intervention, a reserve currency system under structural pressure from shifting global alliances, physical metal inventories declining steadily while paper prices hold at managed levels, these are not subtle or ambiguous. They are clear and readable for anyone who takes the time to look at them with honest eyes. You took that time tonight. That already matters more than most people understand. Stay aware. Stay grounded in what is real. And remember that in a world built on paper, promises, and managed screen prices, the things you can actually hold in your hands are the things that hold their value when everything else becomes uncertain.